Over the last week, the S&P 500 has been fairly mixed right across the board. Industries, however, that has performed very well is the semiconductor, where a lot of stocks are up just double digits in under 30 days. Now our focus in today's episode is going to be on one of those stocks that has outperformed nearly every single company in the S&P. It is Taiwan Semiconductors, up 109% just over the last 12 months. Now we also note we get a double strong buy, one from Quant at 4.96 out of 5, which is very high, another strong buy from Wall Street, and a buy from Seeking Alpha. Now it is trading towards its 52-week highs and is due to report earnings, which we do believe will be very strong over the next few weeks. So let's take a deep dive into this company and understand whether or not we do believe it to be undervalued and a significant buy now. Now, just looking at their latest earnings from July, we do notice that the AI industry continues to boom, which is why a company like TSM has performed very, very well. Remember, they supply their chips to a wide range of very large companies. For example, Apple for their iPhone, their iPad processors, Nvidia for their graphic processing units, Qualcomm, Broadcom, Tesla, AMD, some very large names. Now, how they performed in the previous quarter? Well, we can see 673 billion, which was higher than the expectation by the market of 657, and that also is reflected on the bottom line with a nice beat, 247 versus 238. And these are very impressive when you do consider and compare it to the same quarter from last year. Revenue up 40%, bottom line up 36.3%. It's also very interesting to hear from management about a supply and demand balance. Effectively, they are saying their demand is very, very high and they're finding it incredibly difficult to continue to keep up, which is very good to hear if you are a shareholder or somebody who is essentially invested in a very similar company in the semiconductor space. Bear in mind though, this is one of the best companies in terms of supplying chips to a wide range of customers. Now, in terms of earnings, as we've already spoken about, the expectation moving forwards over the next 4 quarters is double-digit growth to the earnings per share, which is a very strong sign again. On top of that, they have also outperformed in the previous 4 quarters, so a 100% track record, which does give us faith that their December 2025 EPS estimate of 8.35 will be hit, which will bring that forward P down to around 21.7. Now, we do also have to point out that Samsung, who are the world's second largest chip maker, are looking to come in against the industry leader, Taiwan Semiconductor, and take some of their market share. So bear in mind, while there are things that are very strong for this company, there are some competitors that are looking to take some of their market share. At the moment, though, there has been no reflection of this on TSM's continued high market share. Now, one thing that we haven't pointed out is their historical performance, and if you've been a shareholder over the last 10 years, you would have significantly outperformed the S&P, up 832%. In terms of the forward P, well, right now around 27.5. That is higher than the S&P, which is around the 24 mark, and they do pay a forward yield 1.29%, and as we will go through today, they do typically increase those dividends at a double-digit rate. Now let's look at some of their underlying metrics. The first one, dividend safety score, sits at 62 safe. We have an overvaluation, which we can discuss shortly, and as we've already said, they do increase their dividend at a very attractive rate for shareholders. Now, their safe score was reaffirmed at the beginning of August, and this ultimately means that a dividend cut for this company is unlikely. In terms of their key metrics, which does reflect from the last recession or Great Recession, in fact 07-09, they actually cut the dividend, not a good sign. They had below average growth, negative 26%, S&P was negative 12. However, they did significantly outperform the S&P, negative 25% recession return versus the S&P's negative 55. We've already discussed this year's very attractive dividend increase, but this is something they have been doing on a very continued basis over the last 20 years at 18% year on year, although we do note only 1 year of a consecutive increase, but they have been paying a dividend for the last 20 years without a reduction. Now, looking solely at the P ratio, remember we will do our own valuation later. When we zoom into over the last 12 months, what this graph is showing us is that pretty much the blue funnel, which is the expected fair price intrinsic value, TSM has been for the majority over the last 12 months trading above that from March 24 to this point in time. So something to consider if you do look at just a purely P perspective. This company is trading, as we will show you, above the 5-year average. as we can see on the right, 24.6 above 21.2. And when we do typically look at dividend yield theory on this channel, it tells us a company is undervalued when the current yield sits above the 5-year average. So right now, based on these two models, we do get an overvaluation sign, although we do know it sits below the sector P for the information technology, which is 26.5. Remember though, we're not looking at any one of these models in isolation. Now, free cash flow payout below 50% is what we want for semiconductors, not really what we've seen from TSMC. And in fact, over the last year, this is a bit of a red flag indicator, triple digits, which indicates to us management paid out more in dividends than they generated in free cash flow. Not something you would have noticed from the earnings payout, which is why we typically don't look at this data. It is susceptible to manipulation by management through accounting. Positive to note though, over the next 12 months, this is anticipated to come down to around 63%. Makes sense then why they haven't continually been increasing the dividend, and in fact some years they've just been keeping it flat. Now, this industry, as we have mentioned in previous episodes, is very cyclical, so we will see some years very strong, some years very weak. With the free cash flow, we want to see growth consistently over the longer term. Not something we get in terms of that consistency, but it has doubled from 2014 to 2023 and is expected to have some massive growth over the next 12 months to $25.10 per share. And remember, as we heard from management, they don't have that supply to keep up with the very high demand they're having from all of their clients, Apple, AMD, Nvidia, Qualcomm, and others. Now, for a cyclical industry, it is nice to note they've only got 1 year of negative growth. However, that has come in 2023 at negative 5%. We do note on a trailing 12-month basis at 9% is positive. And as we just saw from the same quarter last year, that revenue for quarter is up double digits very healthily, as well as their bottom line net income. And we can see from a numerical perspective, over the last 10 years, they have tripled that top line. In terms of shares outstanding, reason why we focus on this is because companies can return excess cash to investor pockets through share buybacks. We've noticed they've kept it pretty much flat right across the last 10 years, so nothing to note across that point. Then when we look at the ROIC, one of our favorite metrics, 10% or more or 12% for semiconductors, and we notice 20% nearly every single year or in that region, which is a good sign that management are able to effectively allocate their capital. No issues with the margins whatsoever, above 16% and very strongly. Remember, ideally we want to highlight some operating efficiency, which we can see it has increased from 2014 to 2023, and the free cash flow margin, even though it is inconsistent, is still very, very strong year on year, 29% on a trailing 12-month basis. Then we get the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, below 1.5 for the industry. Numbers below are the number of years it would take the company to pay off all of their debt net of cash on hand. Not even 1 day over the last 10 years, not even 1 day expected over the next 12 months. A very strong balance sheet and a very good sign for this company. And remember, this metric does correlate to both balance sheet strength and dividend safety. Now, we also want to point out we have just today released our latest free weekly article. You can click on the pinned comment below, read and sign up straight away. You'll get access to all of these articles that we do send every single Monday morning, where we take a look at what's happened in the market, as well as some undervalued stocks that you need to consider in your portfolio. On top of that, you will be able to pick up 36 undervalued stocks for the month of October, where we also discuss each one that sits within our own portfolio. And you can also grab 22 dividend stocks that Wall Street believe have the most upside right now in the S&P 500. So click below, sign up and read straight away. Other things that we like to do on this channel is look at the institutional movement. Now, ownership sits at 16.51% and we see around 11 billion worth of sales over the last year. Although we see marginally more buyers over the same period, 12.4 versus 10.8. Over the last quarter, though, we can see very minimal difference in terms of buys and sells, and that is pretty much the theme over the last few quarters. So yes, over the last year, institutions have been buying more shares than they have been selling, but over the more recent quarters, we do notice a little bit more sells than buys. In terms of the income statement, now we've already looked at their top line, but we also want to highlight their bottom line. Quick recap, as we can see, their top line has looked very strong over the last 10 years, pretty much tripled from 24 billion in 2014 to 70.4 in 23. We want to identify, does the bottom line show us the same story? And we can clearly see from a graphical perspective, whilst a little bit inconsistent, generally it does move in the right direction, and some very strong growth, 8 billion in 2014, 27 in 2023. Now, we've already discussed their balance sheet is very strong, but let's just take a quick snapshot of their cash versus total debt. And we notice their cash, similar to their top line and bottom line, has been increasing over the last 10 years, going from around 14 billion in 2014 to 63 in that latest quarterly report. Now that is a very good sign, but when we do compare it to their total debt numerically and directionally, what we in fact notice is that it has also increased from 7.9 billion in 2014 to 31.6 in the latest quarterly report. Nonetheless, even though that has also been increasing, as we can see graphically, their cash position is much higher. So as we saw, net debt to EBITDA, not even 1 day for them to pay off all of their debt, net of cash on hand. Now we want to look at some underlying metrics and gradings. The first one is the valuation, where they get a D+. Now we do note on a forward PE, 27.45 currently for TSM is in fact marginally higher than the sector at 24. So right now, if you're buying this company, you are paying a 14% premium, and that is pretty much the same to say for whichever other metric you use. So if you do like this company right now, and it could be justified, this company does trade at a marginal premium. Now, one thing that we do like is their growth is strong at an A- in comparison to the market, 9.44%, sector median at 3.05%, revenue growth 13.17%, higher than the sector at 6.6%, and the thing that we really like to point out from this part of the analysis, earnings per share over the next 3 to 5 years anticipated to grow 26.45% versus the sector median at 15. So it looks good in terms of that growth aspect, and profitability also gives us a very positive outlook. A+, as we can see here, with the gross profit margin, although marginally high at 53% versus 49.7%, the bottom line is significantly higher, 37.9% versus the low single digit of the sector median. We also love the fact their cash from operations are very high, 46 billion versus 96 million in the sector. Now, quick part of this analysis recap, a buy from Seeking Alpha with a double strong buy from Wall Street and Quant. As we've already mentioned, Quant very, very high, 4.96 out of 5. D+ on valuation, A- on growth with an A+ on profitability. Now, final thing before we do take a look at that valuation model, we want to just highlight over the last year when we do compare it to others in the sector, we have Broadcom, AMD, Qualcomm, TXM. As we've already mentioned, a lot of these TSM do supply the chips to these names. And we can see TSM is up there, in fact, the second, third best over the last year, 112% if you do reinvest those dividends, which is incredibly strong. And when we do take a look over the last 5 years, we see a very impressive performance, but we also note this industry as a whole has looked very strong over the last few years. Broadcom very, very strong, AMD also very strong. And when we finally look at the last 10 years and zoom out, whilst we would say TSM very impressive over 1000%, we can see there are some names in the same industry looking significantly better. Regardless though, past performance is an indicator of the future. Just very nice to see that historically speaking, this company has been very good. And if we are to believe that the AI revolution is coming, that the growth is going to be very substantial, then this could be a very strong company to consider in the portfolio. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button. And jumping in, our intrinsic value of $206 has been made up of these three models. First one, we have the multiples valuation model, companies in a similar sector and size, their average P multiplied by the EPS of TSM, and we do see a nice undervaluation signal. As always though, bear in mind we don't look at any one of these models in isolation. And we have the latest yearly payout by TSM, and with the growth rate at 7%, it is much lower than the very high double-digit numbers we just saw earlier in the episode, and we do in fact get another undervaluation signal. Then we move to the DCF model, where we have the free cash flow year on year. Average growth very high at 38%. We've gone 20%, which when we do take a look at the AI industry, the estimates from management, estimates from forecasts and analysts, this looks very reasonable at that point. With a discount rate of 8%, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and as we can see here, our third undervaluation signal. As always then, the intrinsic value is just the average of these three models, coming to $206, which as we can see isn't dissimilar from Wall Street's forecast of $205, where they see upside of 14% over the next 12 months. As always though, we like to use an MOS on this channel, 10% if it hits that 3 criteria. Wide moat, strong financial metrics, good forward-looking data. If you believe that today, well, it is a buy up to $185, then we keep going till it's near the current trading price, and it isn't there right yet. So it's pretty much bang on in today's episode between the 10 to 15% mark. And for those that do want to see a higher MOS, well, a buy at 165 at the 20%, at the 25% at $154. But as we said in today's episode for TSM, between 10 to 15%. Now, this is a very high quality company. As we have discussed already, it supplies chips to some very large names. And while there may be some bearish catalysts coming into the near future, right now the setup for this company does look very good. As we heard from the management team, they cannot keep up with the demand. And we do believe this will continue to be the trend moving forwards, as we saw double-digit EPS growth expected over the next 4 quarters. As always, do give us your thoughts in the comments below. Is TSM one you're looking to buy, one you're looking to hold, or maybe you are looking to sell because you believe it is overinflated? As always, don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below and coming and joining us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.